Hi everyone, my name is Khusboo Dutta from Mizoram University, MBA second semester, roll number 15. So today I am going to explain on the topic national income and its measurement. So let's start the video. First, I will explain introduction of national income. So, what is national income? National income is an uncertain term which is used interchangeably with national dividend, national output, and national expenditure. On this basis, national income has been defined in a number of ways. In common parlance, national income is the total value of goods and services produced annually in a country. In other words, the total amount of income accruing to a country from economic activities in a year's time is known as national income. It includes payments made to all resources in the form of wages, interest, rent, and profits. Second, concepts of national income. So, there are a number of concepts pertaining to national income and methods of measurement relating to them. A. Gross domestic product, GDP. GDP is the total value of goods and services produced within the country during a year. This is calculated at market prices and is known as GDP at market prices. Dernberg defines GDP at market price as the market value of the output of final goods and services produced in the domestic territory of a country during an accounting year. There are three different ways to measure GDP: product method, income method, and expenditure method. These three methods of calculating GDP yield the same result because national product equal national income equal national expenditure. First point, the product method. In this method, the value of all goods and services produced in different industries during the year is added up. This is also known as the value-added method to GDP or GDP at factor cost by industry of origin. The following items are included in India in this: agriculture and allied services, mining, manufacturing, construction, electricity, gas and water supply, transport, communication and trade, banking and insurance, real estates and ownership of dwelling and business services, and public administration and defense and other services. In other words, it is the sum of gross value added. Second, the income method. The people of a country who produce GDP during a year receive incomes from their work. Thus, GDP by income method is the sum of all factor incomes, wages and salaries, compensation of employees, plus rent, plus interest, plus profit. Third point, expenditure method. This method focuses on goods and services produced within the country during 1 year. GDP by expenditure method includes: first, consumer expenditure on services and durable and non-durable goods. Second, investment in fixed capital such as residential and non-residential building machinery and inventories. Third, government's expenditure on final goods and services. Fourth, export of goods and services produced by the people of country. Fifth, less imports that part of consumption, investment and government expenditure which is spent on imports is subtracted from GDP. Similarly, any imported component such as raw materials which is used in the manufacture of export goods is also excluded. Thus, GDP by expenditure method at market prices equals C plus I plus G plus X minus M, where X minus M is not export, which can be positive or negative. B. GDP at factor cost. GDP at factor cost is the sum of net value added by all producers within the country. Since the net value added gets distributed as income to the owners of factors of production, GDP is the sum of domestic factor incomes and fixed capital consumption. Thus, GDP at factor cost equal net value added plus depreciation. GDP at factor cost includes: first, compensation of employees, wages and salaries, etc. Second, operating surplus, which is the business profit of both incorporated and unincorporated firms. Third, mixed income of self-employed. Conceptually, GDP at factor cost and GDP at market price must be identical. This is because the factor cost of producing goods must equal the final value of goods and services at market price. However, the market value of goods and services is different from the earnings of the factors of production. In GDP at market price are included indirect taxes, are excluded subsidies by the government. Therefore, in order to arrive at GDP at factor cost, indirect taxes are subtracted and subsidies are added to GDP at market price. Thus, GDP at factor cost equal GDP at market price minus indirect taxes plus subsidies. C. Net domestic product, NDP. NDP is the value of net output of the economy during the year. Some of the country's capital equipment wears out or becomes obsolete each year during the production process. The value of this capital consumption is some percentage of gross investment which is deducted from GDP. Thus, net domestic product equals GDP at factor cost minus depreciation. D. Nominal and real GDP. So, what is nominal and real GDP? When GDP is measured on the basis of current price, it is called GDP at current prices or nominal GDP. On the other hand, when GDP is calculated on the basis of fixed prices in some year, it is called GDP at constant prices or real GDP. Nominal GDP is the value of goods and services produced in a year and measured in terms of rupees at current prices. In comparing one year with another, we are faced with the problem that the rupee is not a stable measure of purchasing power. GDP may rise a great deal in a year, not because the economy has been growing rapidly, but because of rise in prices. On the contrary, GDP may increase as a result of fall in prices in a year, but actually it may be less as compared to the last year. In both 5 cases, GDP does not show the real state of the economy. To rectify the underestimation and overestimation of GDP, we need a measure that adjusts for rising and falling prices. This can be done by measuring GDP constant prices, which is called real GDP. To find out the real GDP, a base year is chosen when the general price level is normal. It is neither too high nor too low. The prices are set to 100 in the base year. And third, I'll explain measurement of national income. First point, method, output method. The product method is based on returns made by firms and public corporations concerning the annual value of their output. In most countries, these returns are obtained through the census of production. In India, a full census is taken every 10 years and sample censuses are taken in the intermediate years. Additional information may now be obtained from returns with respect to sales tax and or excise duty. Income is measured by the output method by calculating the total value of goods and services produced in the country during the year. The money value of goods and services produced in an economy in an accounting year is called gross national product. It is defined by J.R. Hicks as the collection of goods and services reduced to a common basis by being measured in terms of money. Problems. When we use the output method, certain problems arise. First, unpaid service. The GNP figure includes only productive activity for which payment is received. Any unpaid service will not be included. For example, housewives do a lot of work such as cooking, nursing, drawing of water, coaching children, and so on, but they are not paid specifically for each. Any housekeeping allowance given to the wife by her husband is regarded as a transfer within the family. If, however, another person were employed and paid to undertake the cleaning of house, the payment to him would be included in the figure because she is providing a service for which she is being paid. Second, double counting. Another problem is drawing up the production figures is need to avoid double counting, including the same item twice. For example, the value of the output of the steel industry is calculated, but some of the steel has gone to the car industry to be used in the production of cars. Third, stock appreciation. Another problem arises due to stock appreciation. Some final goods will be added to stocks and not incorporated in other goods in the current year. On the other hand, the value of current output will include the using up of stocks inherited from the past. These problems are dealt with by including net additions to stocks which may be positive or negative in the domestic product. And fourth, international transaction. The value of goods and services produced within the country includes their import content. Imports yields incomes to owners of resources in other countries. They are part of the domestic products of other countries, hence they must be deducted from the GNP. Exports yield income to the domestic factors, so they are included in the domestic product. Their imports is dealt with in the general deduction of imports. Second method, the income method. The income method of calculating the national incomes is based on figures collected from the income tax departments. In advanced countries, the majority of people have to submit returns about income for assessment, so a fairly accurate estimate of total incomes can be obtained in this way. By contrast, in a country like India, where few people make tax returns or where there is wide-scale tax evasion, the income method is not much reliable. Income methods of calculating national income is to work out the total of all income received by people and organizations in the country. The national income includes the income earned by all the resources of the country from their participation in productive activities. The national income can thus be measured by adding up all the incomes earned by the owners of the factor's production. It includes the total of all wages and salaries, earned rents and royalties, interest received on loans, and the profit of companies, private business, farms, fishermen, and traders. This is called national income at factor cost because it shows the cost of production as it is paid out or imputed to the factors employed. Problems of income method. First problem, mixed income. Although this table attempts to separate the payments to different factors of production, mixed income are derived from a mixture of factors. So in practice, it is virtually impossible to separate the returns to land, labor and capital. An example is a wheat farmer whose income is derived from land, capital and labor, all supplied by himself. Again, retailers provide both labor and capital, but we can't find out how much each factor has earned. Second point, transfer income. It is important to include in the calculations only those incomes which correspond to the production of goods and services. Otherwise, there may be double entry. The same income may be counted twice. For example, a worker in a jute mill may receive rupees 2000 per month, of which rupees 302 is taxed away by the government. A freedom fighter received a pension of rupees 300 per month. The total income for both is rupees 2300, yet only 2000 of this correspond to productive activity. Therefore, the pension should not be included. The figure for total income would then be rupees 2000, corresponding to the amount of production involved. And third, imputed income. Only item which often creates problem is ownership of dwellings. People who let out houses for rent are providing a service, so the rents received by them must be included in the national income figures. But account must also be taken of owner-occupied houses. No rent is actually paid here, but the houses provides the same service to the dwellers as rented accommodation. The problem is overcome by imputing a rent to such houses the amount the owners would probably have received if they had rented in the houses. Fourth, government services. There are many services provided by the government of a country which satisfy the collective wants by the community as opposed to the individual wants of the citizens. Thus, administration through the civil service, defense by the armed forces, protection by the police force, justice through the law courts, health care and education are provided by the state. And fifth, net factor income from abroad. Some people and firms earn income by producing goods and services or owning property in other countries. Such incomes will not be included in calculations based on the earnings of factor within the country and must be added to the total. On the other hand, some of the domestic income is earned by non-residents as a result, for example, of the operation of foreign firms within a country. These incomes must be deducted when computing the national income. These two adjustments can be made together by adding net income from abroad if it is positive or by deducting it if it is negative. Third, I will explain method 3, the expenditure method. A third way of arriving at the same total is to add up the total national expenditure. We have to include private and government expenditure and the value of newly created capital. If everything we buy were produced at home, nothing were sold abroad, then the total national expenditure would be equal to the total income and to the national product. But of course, every country trades with others to a certain extent. Thus, unless the value of everything they export is equal to value of their imports, national expenditure will be either greater or less than the national product and income. Problems of the expenditure method. When all the items are added, we arrive at total domestic expenditure at market prices, but this is not equivalent to national income. What we have worked out so far is the total amount spent in this country on goods and services, not the total amount spent on goods and services produced in this country. When we use the expenditure method, the following problem arise. First, exports and imports. Some of goods produced in this country will be sold abroad. For example, when Indian cars are sold in Bangladesh, the expenditure takes place in Bangladesh. Yet the value of those cars will be included in the figure for total production in India. The same is true of all Indian exports. Therefore, if we are to ensure the total production equal total expenditure, we must add to our previous figure the value of exports. With regards to imports, the reverse is true. Money is spent in the country on goods which have not been produced in this country. For example, when we import pears from Australia, the expenditure on those pears is included in our figure for total domestic expenditure. Yet the figure for the production of the peers will be included in the Australian national income statistics and not in ours. Therefore, there is again a danger of losing the equality of total production and total expenditure. To remove this danger, we must subtract the value imports. When exports and imports have been taken into account in this way, the new total is gross domestic expenditure at market prices. And second, indirect taxes and subsidies. However, we don't have an expenditure figure equivalent to the amount which procedures receive for producing the goods and services during the year. For example, the amount paid a consumer for a packet of cigarettes is not the amount received by the cigarettes manufacturer. Part of the price is made up of tax, and that money goes to the government, not to the cigarette manufacturers. And third, factors income from abroad. We have to cover income received from the sale of goods and services produced in this country. But some people in this country receive income as a result of their ownership of property abroad. For example, they receive interest on profits on their assets abroad. Similarly, there is an outflow of money to people in foreign countries who own assets in this country. For example, foreign companies like the Mitsubishi Electric Company have factories in India.